So welcome. This is CPA Part 1 Section 1 Financial Accounting Paper, August 2021. And we'll be doing question 1. So Part A of the question, explain the following types of accounting errors: compensating errors, complete reversal of entry, and error of commission. Then Part B, discuss 3 functions of the IASB. And then question 3, we are supposed to come up with the purchase ledger control account for the month of ended 31st May 2021. So those are the 3 questions. They will give us 20 marks. Let's attempt all of them here very fast. So question 1A, we'll start with question 1A. So solution, and go straight to question 1A, section 1. I think that's how it is. A section 1. 1A section 1, compensating errors. So we are supposed to define what compensating errors are. Compensating errors. Now, what are compensating errors? Compensating errors are, we'll simply say, they are accounting errors. Of course, in the ledgers, when you are posting the ledgers, accounting errors that offset other accounting errors, during posting of transactions in the ledgers. Accounting errors that offset other accounting errors during the posting of transactions in the ledgers. So these are just errors that are, you make an error and I'll say miraculously or somehow you create the offsetting error also in another book so that it goes unnoticed, especially when you are pulling the trial balance. Remember, a trial balance is used to show, if to disclose any errors. If the 2 sides of the trial balance don't agree, that is the debit side and the credit side, if they don't agree, it shows that there are some errors. But now for compensating errors, you make an error in one side of the book, and somehow you also may commit this another error with the same figure in the other side of the book, so that the debit side and the credit side agree. And that's what we mean by saying that accounting errors that offset other accounting errors during posting of transactions in the ledger, so that at the very end the debit side and the credit side are the same. I'll give you an example. You overcast the wages by 2,000. That is, debit side is higher by 2,000, and then somehow you also have an overcast in the sales account, so that the credit side is also higher by the same 2,000 shillings. So the debit side, you increase the figure by 2,000 on wages, and at the same time on the credit side, you have increased the sales figure by 2,000. So at the end of the day, you will find that both the debit and the credit side have been increased by 2,000, the same figure. So the trial balance will not be able to detect that. That is what we mean by compensating errors. Accounting errors that are offset by other accounting errors of the same. The figure in question must be same. It must balance so that the debit side and the credit balance don't actually differ, and in that it makes the trial balance hence not detecting that error. Then we have complete reversal of entry. Complete reversal of entry. This is also an error, and this is where you debit a credit entry. And vice versa. You debit a credit entry and vice versa means you credit a debit entry, so that at the end of the day, both the debit and credit side will balance. So we are talking about the correct figure, and maybe we are talking about the correct, the posting that is done on the correct account. It might be the correct account, the correct accounts that we are talking about here, correct figures, correct account, but different sides or wrong sides. Let's talk of wrong sides of the wrong sides. So these are correct figures, correct entries in the correct accounts, but wrong sides. Instead of crediting, you debit. Instead of debiting, you credit. So at the end of the day, debit and credit are the same. We call that complete reversal of entry, and the trial balance is not in a position to detect that. What you're supposed to debit, you have credited. What you're supposed to credit, you have debited. So that is the complete reversal of entry. Then we have number 3. Number 3 is, what is this? Error of commission. Error of commission. Error of commission. And error of commission, what this means, error of commission. This one we are talking about a posting that is done on the classes, right? The right class of accounts. We talk of the right class of accounts. We talk of the right amount, but then we talk of the wrong account. The right class, the right amount, the right side, and then the wrong account. So for example, if you're talking about debtors, we could be having so many debtors. Omondi could be a debtor, and Amondi could also be a debtor. So instead of debiting Omondi's account, you do what? You debit Amondi's account. So what are you saying here? The right class, yes, you've gotten that right, because all of them are debtors. The right amount, yes, we are talking about the same amount. If you are supposed to debit Omondi with 300, you have actually debited the right amount, which is 300. Wrong account, instead of debiting Omondi, for example, you have debited Amondi. And this shows that it's Amondi who owes the company and not Omondi. So that's where the error comes in. So error of commission, you've captured the right class, you've captured the right amount, but the wrong account. Okay. Then I think we are done with that first part. Let's go to B. B, we are supposed to come up with discuss 3 functions of the IASB. Functions of the IASB. Functions of the IASB. Functions of the IASB. International Accounting Standards Board. Now, it is this board that is mandated with the function of developing and pursuing the technical agenda. So they are the ones who develop this board. They are the ones who develop and pursue the technical agenda. That is the accounting staff. Of course, there are some committees that provide the oversight role, but their key mandate developing and pursuing the technical agenda, and this involves a lot of research on their side. So they basically do a lot of research, in-depth research, so that they can be well conversant with what is happening and factor in all the new changes in their as one of their functions to develop the standards. Then the other function of IASB is to approve the IFRS, the International Financial Reporting Standards. So once the development has taken place, research and whatever, at some point it has to be approved before it can be published. So they are tasked with that mandate of approving and publishing the IFRS to the public. And after that, they also do what? Issue the interpretations. Issuance of interpretations to the public in case there's any need for that. So they develop, they approve, they publish, and they also issue interpretations for that. And why do they do all this? They do all this to ensure that there is harmony in the application of accounting standards. They do all this to ensure that basically there is that compatibility and convergence of the accounting standards. Convergence of the accounting standards throughout the world. You know, these are applicable internationally, worldwide. So the compatibility and convergence of accounting standards is a very important factor here. They also do this to ensure that they uphold the accounting standards. They enforce the rules that have been set. And we can also talk of harmony, basically uniformity. Uniformity, I think, will come under harmony, that we can just have it. So these are the key functions of the ISB, to ensure that there is harmonious application of the accounting compatibility throughout the various states that apply this IFRS, to uphold accounting standards. That means keep on developing on the IFRS and ensure that they conform to the changes, to enforce the standards that have been set and ensuring uniformity in application. But their day-to-day duties are developing, approving, publishing, and issuance of interpretations. So this will give you will be able to give you the 6 marks that are required here. So let's go to part C of this question. Part C, we are supposed to come up with the what? We are supposed to come up with the purchases ledger control account. So that's how it looks. It's a T account. So we just write purchases ledger control account, purchases ledger control account. This account, and we have the credit side and the debit side. So these are purchases ledger control account. For a purchases ledger control account, anything that increases the liability, we credit. Anything that reduces liability, we debit. It's as simple as that. So if we buy more goods on credit, we are increasing our liability, we credit. If we pay, for example, for the goods that we purchased, we are reducing our liability, so we debit. It's as simple as that. That is the rule. And then at the very beginning, just follow the instructions as they are. If they tell you debit balance and credit balance, just take it as it is. Why? Because control account is a summary of so many other creditors in the business. So there's a possibility that some creditors have been overpaid, then there are some creditors that we actually owe them money. So it's okay to have both debit balance and credit balance. Remember, this is a summation of all the creditors in the business. So it's okay to have debit balance and credit balance. Just take them as they are. Now you can see these are debit balance of 980, balance on purchases ledger as at 1st May 2021. Debit balance 980, credit balance 2.99. So what you need to do is just come here and indicate the date. This is 1st May 2021. So you might want to show the date. 1st May 2021. Remember, the format is always date, and then we always start with the date. So first, sorry for that. Sorry, looks like this thing is just a minute. Okay, so we proceed. So first, May 2021, balance brought forward. How much do we have? Balance brought forward. How much do we have? This is 980,000. Just read it. It's a debit balance 980,000. So you just read it as it is. So 980,000. And then the same date, 1st May 21, balance brought forward on the credit side is 2.990, like that. Okay, so I think that one is okay. Just take the instructions as they are. Purchases, ledger, debit, credit. Then transaction during the month of May 2021. So purchases on credit. When we purchase on credit, we are increasing our liability. So we simply credit the purchases ledger. So purchase on credit at 9245. Simply come here and say purchases, credit purchases 39,245,000, like that, so that you are increasing our liability. Then purchase returns. We return some of these goods to our suppliers. That has the effect of reducing our liability. So purchase returns 895. Purchase returns 895. So we come here and say purchase returns 895,000, like that. Then the next one, checks paid to trade payables. Checks paid to our suppliers, we are reducing our liabilities. So checks paid 23,370. Checks paid 23,370. So checks paid 23,370. Then the next one is cash paid to trade payables, the same thing, 6515. Cash paid to trade payables. So simply come here and say cash paid 6515, like that. 6515. I hope I've captured the figure correctly. Yeah, 6515. Discount received from trade creditors. They have given us the discount, so we are the ones enjoying the discount. So this has the effect of reducing our liability. So discount received 1155. Simply come here, say discount received 1155, like that. Next. Credit sales offset against credit purchases. Credit sales offset against credit purchases. I assume that suppliers bought goods from us on credit, and instead of paying us, we are to offset that figure from the credit, from what we owe them. So that has the effect of reducing our liability. So credit sales offset against credit purchases 1780. So we'll simply talk of an offsetting credit sales. The figure was 1780, like that. Good. Then credit purchase of a motor vehicle posted in the purchases ledger. Credit purchase of a motor vehicle posted in the purchases ledger. A purchase of motor vehicle is not supposed to be posted in the purchases ledger, but nevertheless, it's a credit purchase, and this is a summation of all the credit purchases. So we'll still have it. Purchase of a motor vehicle 2990. Purchase of a motor vehicle 2990. So motor vehicle purchase 2990. See the figures of the same. Okay. Then finally, I think we have one more item to go. Balance as at 31st May. This is a debit balance of 885,000. Now, when they talk of a debit balance as at 31st May, this is the balance that we are talking about here, debit balance. You can see debit balance 980, and we interpreted it as being on the debit side. So here, balance as at 31st May 20, it's a debit balance of 885. It should appear on the credit side of the purchases ledger control account, so that when we open when we start the next financial period, it will appear on the debit side, the equivalent of this, what we are seeing here, this this debit side here. So balance as at 31st, it's a debit balance of 885. It should appear on the credit side for now, so that the next financial period it appears on the, so 31st May 21, we will say balance carried down. This is a debit balance of 885,000, like that, 885,000. So if they had also given us a credit balance, then we'll simply have input our credit balance here, and when you get the total, it will automatically balance. But since they have not given us the credit balance, we'll have to work out and get the total, so that we can find our credit balance by ourselves. Of course, the credit balance will now be on the debit side, so that when we start the next financial period, it now appears on the credit side of the purchases ledger control account of the next period. So here we are going to add this side. The credit side looks complete, so we are going to add on the credit side, and then find the difference, which most likely will be on the debit side of this book, plus 885,000. That gives us 46,110. So this is the balancing figure, 46,110,000. So here also we'll have 46,110,000. Then get the total here. The difference is what will come here as the closing balance. At 1st May 2021, we'll have balance carried down. This is the credit balance, which the next financial period will now appear as the credit balance. So let's get the total. This is 980 plus 895 plus 23,370 plus 6515 plus 1155 plus 1780. That gives you that 4695 minus 46,110. What we get is 11,415. So 11,415, like that. So this is the balance carried down on the credit side. So the next financial period will be talking about balance brought down of 11,415,000, and here we'll talk about balance brought down of 885,000. So you can see this is how we interpret. So debit balance is this, credit balance is this, and that's how we are going to start the next financial period. So that is it. That's how you go about it. Please mark the key things here. Purchases control account, anything that increases the liability on the credit side, anything that reduces the liability on the debit side. Full stop. Thank you. Continue following us for more worked examples.